Good evening, and thank you for joining us. Tonight we begin with a developing story inside the global silver market, one that is drawing significant attention from commodity analysts and physical metals traders alike. At the close of today's session, registered silver inventories on the COMEX-Exchange, the metal formerly available for futures contract delivery, settled at 81.7 million ounces. That figure represents a continued and notable decline in physically deliverable silver held within COMEX-approved vaults, and it is raising serious questions about the relationship between paper-based futures contracts and the actual physical supply of the metal. To understand the full weight of that number, consider this. Open interest on COMEX silver currently stands above 113,000 contracts. Each contract represents 5,000 ounces of silver. That places total paper claims at over 565 million ounces, against a registered physical base of just 81.7 million ounces. That is a ratio of more than 7 paper claims for every single ounce of registered deliverable metal in the system. At the same time, a significant and sustained pricing divergence has emerged between Western and Eastern silver markets. In Western spot and futures trading, silver closed the session at $84.34. Meanwhile, the equivalent settlement on the Shanghai Futures Exchange closed at $96.75, a difference of exactly $12.32 per ounce. That premium has not collapsed. It has remained stubborn, and analysts tracking physical metal flows say it reflects a very real and directional movement of physical silver, out of Western vaults and into Eastern hands, or directly into industrial supply chains that are not releasing it back into the open market. To fully appreciate what the registered inventory number of 81.7 million ounces actually means, it is important to distinguish between two categories of silver held within the COMEX system. The first is registered silver, metal that has been formally designated, certified, and is immediately available to be tendered against futures contracts upon delivery. The second is eligible silver, metal that is customer-owned, stored in COMEX-approved vaults, but not currently available for delivery unless the owner chooses to convert it. The total COMEX stockpile, when combining both categories, is higher than the registered figure alone. However, it is the registered number that carries decisive weight when delivery obligations come due. That is, the war chest, as traders refer to it, and that war chest is draining. With open interest holding above 113,000 contracts, each representing 5,000 ounces, the total paper obligation on the system exceeds 565 million ounces. Against 81.7 million ounces of registered metal, that represents a minimum leverage ratio of 7-to-1. Analysts tracking COMEX mechanics note that this is the precise type of structural setup that has historically preceded significant delivery squeezes. When delivery notices begin accumulating, as they are already doing in the current March contract cycle, the process becomes mechanical and unforgiving. A delivery notice is issued. The short position holder is obligated to supply physical metal. The long position holder takes possession and removes that metal from the vault. Registered inventory drops. While eligible metal can sometimes be converted to registered status to meet demand, that conversion is neither guaranteed nor unlimited. This brings the conversation to a broader structural issue, one that extends well beyond any single trading session. According to data from the Silver Institute, the global silver market has now recorded a supply deficit for 6 consecutive years. Annual mine production globally sits in the range of 800 to 850 million ounces. Recycling and scrap recovery contribute approximately 150 million ounces on top of that. Combined, total annual supply barely surpasses 1 billion ounces. On the demand side, industrial consumption alone is absorbing more than 600 million ounces per year, and that figure is rising. Silver's role as the most electrically conductive metal on Earth makes it indispensable across a wide range of rapidly expanding industries. Solar panel manufacturing, electric vehicle production, fifth-generation wireless infrastructure, and artificial intelligence data center construction all require silver in meaningful quantities. No substitute exists at industrial scale that matches silver's conductivity and performance characteristics. Beyond industrial use, jewelry and silverware account for an additional 200 million ounces annually. Investment demand, including exchange-traded funds, physical bars, coins, and accumulation by nation-states, absorbs the remainder. When those demand categories are totaled against available supply, the Silver Institute's data points to a deficit of approximately 67 million ounces in the current year alone. That shortfall is not an isolated event. It compounds on top of deficits from the previous 5 years, pushing the cumulative above-ground stock drawdown into the hundreds of millions of ounces. The physical buffers that historically cushioned the market during periods of supply stress have been substantially diminished. We turn now to the pricing divergence between Eastern and Western silver markets, a gap that analysts say is not a rounding error or a temporary anomaly, but rather a reflection of fundamental physical reality. As reported at today's close, Western spot and futures markets placed silver at $84.34 per ounce. The Shanghai Futures Exchange equivalent settled at $96.75, a locked premium of $12.32. That premium has remained persistent and has not shown signs of collapsing. Analysts tracking cross-border metal flows interpret this as evidence that physical silver is moving in one direction, out of Western storage and into Eastern industrial and sovereign hands, and is not returning at current price levels. The reasons that arbitrage traders cannot simply close this gap are both structural and practical. Shipping costs, insurance premiums, import tariffs, and outright trade restrictions make it economically unviable to move physical silver from east to west at current prices. China, India, and Russia have been actively accumulating physical metal. China has additionally implemented export restrictions on certain refined products, effectively retaining more domestically produced metal within its own borders. The result is that Western markets are competing for a shrinking pool of available physical supply, while Eastern markets pay a substantial and sustained premium that reflects their own physical demand reality. The Western futures price in this context represents the cost of a contractual paper obligation, one that may never result in actual physical delivery. On the macroeconomic front, several converging forces are adding pressure to an already strained supply picture. United States national debt has surpassed $38 trillion and continues to climb. Interest payments on that debt are approaching levels that rival national defense spending. The Federal Reserve faces a constrained policy environment. Raising interest rates further risks fracturing credit markets and economic stability, while cutting rates risks reigniting inflationary pressures. Currency tensions are escalating globally. BRICS nations are expanding trade settlement arrangements that operate outside of dollar-denominated systems. Geopolitical instability in the Middle East, including ongoing tensions in the Gulf region and disruptions to Red Sea shipping lanes, is creating potential supply shock scenarios for energy markets. Historically, when energy prices spike on geopolitical pressure, safe haven capital flows accelerate into hard assets, gold first, and subsequently silver. Silver occupies a unique position at the intersection of monetary demand, industrial demand, and geopolitical safe haven demand simultaneously. Regarding the practice of spoofing and market manipulation in futures markets, this is not a matter of speculation. It is public record. Major financial institutions have been fined by the Commodity Futures Trading Commission for placing large fictitious sell orders designed to artificially suppress prices, then canceling those orders and purchasing at the suppressed levels. Settlement agreements, including those involving J.P. Morgan in connection with silver futures, resulted in billions of dollars in fines and formal admissions of wrongdoing. The practice involves suppressing the paper price, maintaining the futures-based pricing system, and collecting carry in the interim. However, analysts note that physical delivery cannot be manipulated in the same manner. When registered inventory sits at 81.7 million ounces and continues to fall, the ability to sustain paper-based price suppression through spoofing becomes increasingly compromised. Delivery notices being issued in the March contract cycle require physical metal to change hands, and that metal, once removed from registered inventory, does not return. From a technical analysis standpoint, silver closed above its 150-period exponential moving average on the daily chart, a level widely monitored by institutional traders and algorithmic systems. Support has been established in the range of $82 to $83 per ounce, a level that is held through multiple tests. Resistance levels are identified at $86 to $87, with the next significant psychological threshold at $90. Trading volume at the close was reported as heavy, and open interest did not collapse, an indication that short positions are not being covered with ease. Gold, meanwhile, closed at $5,172 per ounce, defending the $5,000 level firmly. Historically, when gold holds key support levels, silver tends to follow with amplified movement, a function of its higher volatility relative to gold. The gold-to-silver ratio remains elevated above 60 to 1. Historical compression of that ratio has been associated with silver price advances of 20, 30, and in some cases 50% within compressed time frame. On the supply side, there is no near-term relief anticipated from mining operations. New silver mine development requires between 10 and 15 years from initial discovery through to full production. Existing mines are experiencing declining ore grades. Energy costs, labor costs, and environmental compliance costs are all rising. Byproduct silver, recovered as a secondary output from copper and gold mining operations, is operating near maximum capacity. At current prices around $84 per ounce, new mining projects remain marginally economic after accounting for inflation. Industry analysts have noted that the incentive price necessary to bring meaningful new supply online is estimated to be north of $120 per ounce in today's dollar terms, a level the market has not yet reached. Before we summarize the key data points from today's session, responsible and intellectually honest reporting requires that we present the legitimate downside risks that analysts have identified alongside the structural pressures we have outlined throughout this broadcast. These risks are real, they are acknowledged, and they deserve equal attention. The first risk factor is dollar strength. If geopolitical instability in the Middle East were to drive oil prices sharply higher in a compressed time frame, the United States dollar could rally on safe haven flows and tightening Federal Reserve expectations. A stronger dollar historically exerts downward pressure on commodity prices in the short term, and silver would not be immune to a violent price flush under those conditions. The second risk is profit-taking. The price movement from the $60 range to the current $84 level has been rapid and parabolic in nature. Technical indicators, including the relative strength index on the weekly chart, are registering overbought conditions. A corrective pullback to the $78 or even $75 range is considered possible by analysts, as institutional participants take profits and algorithmic systems amplify the move downward. The 150 exponential moving average, currently acting as support, could temporarily function as resistance on a retest from above. The third risk is a broad liquidity event. Should equity markets experience a significant crack or credit spreads widen sharply, correlated assets across the board tend to be sold as leveraged positions are unwound. Silver is not exempt from this dynamic. Events in 2008 and 2020 demonstrated that rapid deleveraging can hit long positions in silver quickly and aggressively, with open interest dropping sharply as weaker market participants exit. The fourth risk involves geopolitical resolution. A ceasefire announcement or a meaningful reduction in perceived oil supply risk could rapidly diminish the safe haven bid currently supporting silver prices, resulting in a swift reversal of recent gains. The fifth risk concerns above-ground stock releases or accelerated recycling. If eligible metal is converted to registered status at a sufficient pace, or if elevated prices draw a surge in scrap silver supply, the immediate delivery squeeze pressure could ease in the near term. The sixth and final risk is regulatory intervention. Exchanges retain the authority to raise margin requirements, impose position limits, or in extreme circumstances, suspend trading. Precedent for such actions exists in the historical record. Each of these risks is legitimate. Each could influence price action over a period of weeks or months. However, analysts are careful to note a critical distinction. None of these bearish scenarios address the underlying structural deficit. None of them refill registered COMEX vaults. None of them reduce industrial demand from solar manufacturers, electric vehicle producers, artificial intelligence infrastructure builders, or electronic supply chains. These risks represent timing uncertainties, not fundamental thesis reversals. The paper-based future system may delay the physical reckoning that supply and demand mathematics implies, but it cannot permanently override the physics of a market running a 67 million ounce annual deficit for the sixth consecutive year. With that full and balanced picture established, we now bring together the complete summary of today's key data points, as reported at market close. COMEX registered silver inventory settled at 81.7 million ounces and continues to trend lower. Open interest on silver futures remains above 113,000 contracts, representing over 565 million ounces in paper obligations, a leverage ratio of more than 7-to-1 against available registered metal. The Shanghai Futures Exchange silver equivalent closed at $96.75, locking in an east-west price premium of $12.32 per ounce that shows no signs of collapsing. Western spot and futures silver closed at $84.34. Gold closed at $5,172 per ounce, maintaining its defense of the $5,000 support level. March delivery notices are accumulating against a registered inventory base that is actively declining. The global silver market is in its sixth consecutive year of structural supply deficit, with the current year's shortfall estimated at 67 million ounces. Industrial demand from solar energy, electric vehicles, fifth-generation wireless networks, and artificial intelligence infrastructure continues to expand while mine supply remains essentially flat. The gold-to-silver ratio remains above 60-to-1. Technical support is holding in the $82 to $83 range, with resistance identified at $86 to $87, and the next significant level at $90. The divergence between Eastern physical pricing and Western paper pricing has reached levels that analysts describe as historically stubborn and unresolved. The data presented in tonight's report is drawn from CME Group registered inventory figures, Shanghai Futures Exchange settlement records, and Silver Institute supply and demand balance tables. Viewers are encouraged to consult those primary sources directly to verify the figures discussed throughout this broadcast. That is our complete report on the silver market for this session. The numbers are on record. The inventory figures are publicly available. The pricing divergence between East and West is documented, and the structural supply deficit is now in its 6th consecutive year. We will continue to monitor developments in this market and bring you updates as conditions evolve. For the entire team, thank you for watching and good night.